And welcome everyone to this 8th episode already of our CFO Insights podcast. And today I'm really honored to have the presence of Anais de Scitivaux, who has very recently joined PwC as a senior manager in our investor relations practice. Welcome, Anais.
Thank you. Happy to be here.
Yeah, and Anais, perhaps immediately jumping into the investor relations practice. Because I know for a lot of some of the companies I work with, but also a very common concern among CFOs, CEOs of a listed entity really is the question, is my company correctly valued by the market? And often a company's capitalization does not really align with what management or the company itself believes to be its intrinsic value. Could you perhaps just help me explain why this discrepancy in valuation and what can be done to bridge the gap?
Yes, indeed, Roel, you're right. We see many companies who feel that the market capitalization doesn't reflect their true value. And there may be a lot of different reasons that explain that. It could be global factors that are beyond their control, for instance, like geopolitical instability or financial crisis. A good example of that is what happened with the COVID crisis. Because we saw that the COVID crisis affected the company across the board, even in sectors whose operations were not impacted by the crisis. I'm thinking here of the telecom sector, for instance, because the telecom sector, their operations were not impacted by the crisis. On the contrary, you could even think that they would benefit from the need of alternative communication mode. But nevertheless, initially, their market cap took a hit. So that's really something that is beyond the control of company. But what we typically see is that it's a temporary effect, and that's after a while, company gradually recover from it.
Yeah.
Next to that, you can also have sector-specific factor that really play a role in the undervaluation. It could be, for instance, technological disruption. It could be regulatory changes. A good or an interesting example of that is what we've seen in the insurance industry 2 years ago with the change in the accounting framework. With the shift to IFRS 17, investors didn't feel fully able to properly assess the performance of companies. They didn't understand at first completely the framework and what it meant for the company. And so what happened is what usually happens in this case when there is uncertainty is that investors tend to stay away from the stock.
Yeah, a bit of a wait-and-see approach.
Exactly.
Yeah.
That's exactly that, a wait-and-see approach until they get a better grasp at what is happening.
Yeah.
So that's something that we saw weighted really on the stock there, on the sector. And next to these factors that are kind of market-wide factor, if you want, obviously there could be some company-specific factors that play a role and that really weighted on the valuation of a company. It could be a struggling business line, or it could be linked to the country in which the company operates. For instance, with the recent election in the US, you can think that it could lead to increased trade tension between the US and China, and therefore that investors could have concerns over companies that are largely exposed to China. I would stay away from it. Or it could be linked to concerns over the structure of the company. If the company is perceived as a conglomerate with business lines without much synergy between them, then the company could be suffering from a holding discount. Or it could be concerned over the strategy, M&A strategy, capital deployment strategy.
Yep.
So really, my point here is that there are many different factors that could explain why a company is being undervalued. And what we typically see is that it's very rarely a single factor that plays a role. It's usually a combination of factors, a mix of factors. And therefore, that's really important for a company when it feels that it's undervalued to make an in-depth assessment of the situation to really understand where this undervaluation is coming from, what is bringing this discrepancy.
Yeah, what's the driver there indeed? So, but okay, you mean an in-depth assessment, but I imagine it's easier said than done in practice. So how should companies go about doing this assessment? Are there specific methods that you have to start with it and execute on that?
Yes, a good starting point is to do a detailed analysis of the valuation model that is used by the sell-side analyst. And in particular, to look at the sum of the parts, because it will enable company to see which part of their company is valued out much. And therefore, they will be able to see if they're suffering from a global discount on the entire company or if it's coming from specific part of the business. So that's really an interesting information to get. And next to that, I would strongly recommend companies to do a perception study to gather the feedback from investors. So that's been really interviewing analysts, shareholders, investors to get their concern and their view on the company. And it's especially interesting to interview people who are not investing in your stock, but who are investing in peers, because that means that your stock would fit in their investment criteria, but they don't feel positive about your investment case. So their feedback is particularly interesting. And really carrying out this perception study really enables company to have the necessary insight to make strategic choices that would be welcome or at least supported by the market. For instance, if you find out that you're suffering from a holding discount, you could consider doing a spin-off like Solvay did a year ago. Or if you find out that the adverse sentiment is coming from a specific business line or a specific market, you could consider exiting it. Or if you're a biotech and you find out that the market feels that you have a too long time horizon, you could consider doing an M&A with a shorter duration portfolio, for instance. That doesn't mean, obviously, that the market should be driving the strategy of the company. Of course not, because your interests may not align. You can have short-term investors with short-term view, while the company needs to have a longer-term horizon. And additionally, your perception of the potential of a market may differ from the perception. But what is interesting is that in both cases, this is an investor relation issue. That means that either the company failed to communicate convincingly about the market potential or failed to target the right profile of investors.
Yeah, indeed. Indeed, because there it gives you at least insights into how the investors look at you, but then you need to look at what's the gap here, and how can I remedy that situation? How can I remedy that gap and make sure that I improve my alignment on my story with my investors? So how can you go about remediating that?
The first obvious step is to provide a very compelling answer to the question, why should people invest in my stock? That's really the crucial question. And you have to keep in mind that your investment case is competing with multiple other investment cases. So investors are faced with multiple options on a daily basis. So you need really to be able to grasp their interest quickly. And that is why really drafting a compelling equity story is fundamental. And the equity story is really the narrative that supports your investment case.
Okay. Easier said than done, obviously. So how do you now exactly draft that compelling equity story? Are there specific steps that you can take?
We used to say that there are 4 factors to keep in mind when you want to draft an equity story that truly resonates with investors. They are called the 4 C's of the equity story. The first one is to be clear. That seems quite obvious, but in fact it's important because, as I said before, investors see many investment cases every day. So they need to be able to grasp your value proposition very quickly. And that means also that you want something that is easily understandable, not only by sector specialists, but also by generalists. You don't want to deprive yourself of a potential pool of investors by being too technical or by being too complex. So use straightforward language, avoid complexity whenever you can, and you can also use, of course, a visual aids like chart and graph to make your story accessible. So that's the first element, be clear. The second one is be concise. And what I mean by be concise is keep it streamlined to the essential element. If a business line is not contributing significantly to your business, to your operation, to your result, don't mention it. If a market is not contributing significantly to your result, don't mention it.
It can only distract. It can only distract.
It's only distract. Exactly that. Keep it focused on what you want people to remember by the end of the meeting. That's enough. So that's clear, concise. The third element is compelling. Again, that seems quite obvious, but I think it's worth focusing on nevertheless. That means really providing a convincing answer on why you're uniquely positioned to succeed in your market, and how this will translate into returns. Of course, that's key. That's really explaining your business model, and really, I insist on that. Explain why you're uniquely positioned to succeed in your market. What are your specific advantages in your market?
And that's also where the passion comes out and the proud on the company. But aside from that, sometimes it's also probably spoken learned. So I think also KPIs.
But you're absolutely right. And when you're thinking about KPIs, it's very important to choose KPIs that are really aligned with your strategic goals and with your story. So, for instance, if your story is about capital return, then you might select KPIs like free cash flow generation or dividend increases. But if your story is more about long-term growth, then you might have KPIs like top-line growth or EPS. If your story is about improved profitability, then you can choose KPIs like margins or like cost reduction. So it's really important to be strategic in your choice of KPIs. Ideally, you would align with the industry practices because it will also enable analysts to make comparison with peers, and also that's KPI that are well known, so that's easier for everybody. But if you feel that this KPI won't allow to properly assess your value creation, then feel free to create your own KPIs. But please make it simple and explain it carefully. Keep in mind that if investors don't feel comfortable in their ability to properly assess the value you create, they will stay away from your stock. So keep it simple and explain it carefully. And of course, keep it consistent over time.
I was just about to say, making sure that once you select the KPIs, that you consistently report on them. Because otherwise you will bring up a lot more questions, I guess.
Exactly.
And actually that brings us perhaps to the fourth point also, the credibility, I guess.
Exactly. So credibility, that means supporting really your equity story with data. Your track record should really back your ambitions. And in terms of ambitions, you need to set projections that are realistic and achievable, and really regularly update your investor on your progress. And something else that is very important in terms of credibility is transparency. That means being transparent about the challenges you face. Every company faces challenges from time to time. That's normal in the company life. That's okay. But what is important is not to hide it or cherry pick numbers, because investor will see through it immediately. And on the contrary, I would urge you to be transparent about the challenges and explain the measure you put in place to address them and to mitigate the risk going forward. And really, this transparency will build trust over time. So you have clear, you have concise, you have compelling, you have credible, and I would add a fifth one, concerns-oriented. I'm not sure it's a word, concern-oriented, but I guess you can understand what I mean. My point is that it's always better to proactively address potential concerns in your equity story if you can. So you usually know what the pushback to your investment case will be. So if you can address them proactively and already bring convincing answer, that's will make your equity story more impactful.
Okay. And then perhaps going from there, if you have that compelling equity story, perhaps the next question is, because we've talked about the investors on the one hand, your equity story, but can a single equity story really resonate with all of those investors? Because we also already mentioned profiles differ, investment criteria may vary very wildly, really. Or do you target specific investors? Do you adapt your narrative?
That's a very fair point. The first element to keep in mind is that your value proposition will not appeal to all investors. Yeah. And that's okay. That's normal, because every investor have their own criteria, their own investment mandate. It could be in terms of size or market capitalization, sector, geography, fundamental, whatever. So you won't fit to all investors. So that's very important to target compatible investors. And if possible, also investor whose long-term vision will align with yours. So you have long-term alignment in terms of interest. But even with compatible investors, you cannot have a one-fits-all communication. I said, and the equity story is unique, but nevertheless, you need tailored communication approach. I will give you a very concrete example. If you're meeting with a pension fund manager, what he's interested in is having a long-term, reliable retirement income. So he will be interested if you talk to him about the long-term potential of the company and also how you mitigate risk. If you have a solid corporate governance framework, for instance, and your risk policy, your risk management. Yeah. But if you're meeting a hedge fund and you're talking to him about long-term potential and risk management, that will probably not resonate with him, because he will be more interested in maximizing the short-term returns in order to outperform indexes. So you have to really do your research carefully before meeting investors in order to identify their investment criteria and therefore to find which part of your equity story you want to push forward and to highlight. And this really will make your communication far more impactful.
So as really in everything, preparation is key and having a good sense of who your audience is.
Of course.
I agree, it's the upfront information gathering and analysis that are really key, if I hear.
Yeah, that will make all the difference. You're absolutely right, yes.
Okay. Perhaps zooming a bit more onto that investor base, that shareholder base. Is there really an ideal investor base? Should companies really mainly target those long-term investors? They are likely to be more loyal. I'm making assumptions here.
That's a good point. I would say that ideally companies should aim to have a diverse shareholder base because it reduces dependency on a few large investors and that mitigates the risk of significant stock price volatility due to the factors of one investor. Yeah. And it also broadens the pool of potential capital for fundraising. So when you are organizing a roadshow, I would recommend trying to meet a mix of existing shareholders and potential new investors. Yeah. It's important to meet regularly your existing shareholders because you want to make sure they remain confident in their investment. So you need to meet them regularly, keep them up to date in terms of the progress you make and how the company is doing. But it's also important to meet new investors to diversify and expand your shareholder base. And when you are targeting new investors, it's important to reflect on the changes you would like to make to your shareholder base. What I mean is that, for instance, if you feel that you don't have enough liquidity, you might target retail investors. If you feel that, to come back to what you mentioned before, you mentioned a long-term partner. Indeed, if you feel that you're at risk of hostile takeover or shareholder activism and you want to secure a long-term partner, so that's a different profile of investor that you want to be targeting. Or it could be that you are trying to increase your visibility in a specific geographic market, and then you might want to increase your shareholder base in this market. So my point is, in any case, you have to be really strategic about your targeting, not just go blindly and find whoever is interested, but really find investors that fit with your ideal shareholder base.
So it's actually what I hear is also here preparation is a bit key, knowing what is your ideal as a company, your ideal investor base, and then actively going out to the market and trying to get there.
Yeah, that's absolutely true. Preparation is key, and when you're going out there and meeting them, I would also add that it's important not only to present your investment case, but also to gather feedback.
Yeah.
And that's really a great opportunity for you to, first of all, hear the concerns by the investors so you can address them more efficiently. But also it means that you get to meet people who very often have a good knowledge of your industry and of your peers. That means that they can come with fresh ideas, innovative ideas of what you could be doing. So it's a very interesting insight that you can hear from them. And lastly, obviously, like everybody else, if investors feel that they are being heard and they are being valued, it will enhance their confidence in the management and it will secure their loyalty.
Yeah.
And this may prove really, really useful at critical times. Yeah. For instance, if you're facing, we mentioned it before, shareholder activism, or hostile takeover bid, or crisis, or whatever, then being able to rely on a solid shareholder base with whom you have a strong relationship will really help you manage the challenges far more easily. It could make all the difference.
Yeah, because indeed it's about the numbers on the one hand, and that's not to kill ourselves, it's a big part, but in the end it's also about the story and the relationship.
And the relationship is key.
Yeah.
So really use the interaction with your investor and show that you value their input and that you are willing to listen and to adapt.
Yeah, okay. No, very good. Thanks a lot for that, Anais. And I know we jumped really right into it on investor relationships, but you have some experience or a lengthy experience of managing investor relations at a few listed companies. So perhaps as a final question here, like what brought you to PwC? Why can we now, are we so happy to host you here?
Thanks a lot, Roel. Indeed, I have 10 years experience in investor relation in listed companies. And before that, I spent 10 years advising companies on how to communicate with capital market during IPOs and post-listing. And something I would like to add is that before coming to Belgium 10 years ago, I worked in the UK and in France. And I was really struck by something, is by the different way investor relation is done in this market. In France and to a larger extent in the UK, companies tend to rely heavily on specialized agency for their investor relation and for their financial communication. And SMEs often outsource investor relations to specialized agency, and it really enables CFOs to rely on a very strong expertise for a cost that is less than a full-time employee. And for large companies, it's a bit different, obviously. So you always have an internal team of investor relation. So it's more about ad hoc support during pivotal times. So it could be really reshaping the equity story after transformative M&A. It could be assisting in crafting robust communication strategy in times when you feel that your valuation is under pressure. So we found that there was clearly a market gap in Belgium compared to other markets, and we were hoping to bridge this gap.
Okay, good. Good luck in any case.
Thanks a lot, Roel.
Yeah, and I would say it's welcome to PwC and good luck with the opportunity. I, for one, had a very interesting talk with you. It was very interesting listening to the story you bring, really, about the investor relations, the shareholder base, and how to draft that compelling equity story. So I'm very happy to, very looking forward to at some point see your work. I definitely enjoyed and learned a lot from it. I'm sure our listeners will have too. And I would like to thank you especially and everyone else for listening in to this 8th episode already. Thank you.
Thank you, Roel, for inviting me.